Hi everyone, welcome back. Today I'm going to be showing how to find the intrinsic value of a company using the PE based valuation and the dividend discount valuation. So before we begin, if you like the spreadsheet, you can just go to my Patreon page. The link will be down below on the description. You'll have full access to it. You'll be able to do your own research and have your own portfolio tracker. Also, if you like the content, please hit the like button and subscribe. It would be much appreciated. So back to the video. Um, to find the PE base valuation, which is a ratio, a financial metric used to evaluate the value of a stock, it compares the market price of a stock to its earnings per share. A high PE ratio suggests high growth expectations, while a low PE may indicate lower growth expectations. So this is just going to calculate it and give us an average, and with that average we're going to use the growth rate to get a future intrinsic value, also a present value. Okay, so once we get the 10-year future intrinsic value, it doesn't mean it's going to take 10 years to get to that price, but it does mean within these 10 years it should hit that price. So all this data just automatically fills in because we put stock ticker symbol right here. We put Pfizer before, so it automatically fills in, giving us the ticker here, the current price, and the earnings per share. So all we have to do is find the 5-year high PE and the 5-year low PE. So all we have to do is go on this site, put in ticker symbol. You can use any of the other site. I just think this is easier. Okay, we go to price ratio, and as you can see, we have PE ratio right here. So what we want to do is put a 5-year chart, and we can see the high would be 2271, as you can see, PE ratio. So we plug in 2271, and we want the low now. Yeah, okay, the low should be 787. So we plug in 787. Okay, and this gives us an average of the PE, and the growth rate I'm going to leave 722 because that's the S&P 500 30-year growth rate, which is very accurate to me. It's stable growth rate, so I'll leave it at that. And as you can see, the 10-year future intrinsic value comes to 55, pretty close to this intrinsic value from the future free cash flow. Okay, so what this indicates is that in the next 10 years the price should come to 55. It doesn't mean it's going to take 10 years. It means it should within these 10 years come to 55. The present value of the intrinsic value is $21. That's the current price it's giving us. Okay, so it gives us a buy price of $15. I think that's a little low, but that's why we need all these metrics to come together to give us a more precise intrinsic value. So next I'm going to do the dividend discount valuation, which is a method for valuing stocks that pay dividends. It estimates the intrinsic value of a stock by calculating the present value of its expected future dividend payments. The model involves forecasting future dividends, discounting their present value using the required rate of return, and summoning them to determine the stock's intrinsic value. Okay, so what we're going to do is we're going to come to this site right here. Okay, we put in stock ticker symbol PFE. Okay, now what we want to do is come to historical data, and we want to put a 5-year span and historical price. We want to put in dividends only and apply. Okay, this is going to give us all the dividends it paid in the last 5 years. So we're going to do every 4 quarters. Okay, and as you can see, we have different prices. So we get 0.41, 0.41, and 0.40. Okay, so what I like to do is just relatively easier, just use the calculator, put 41 and for those three and 0.40. Okay, and this is gonna be 0.41. It was easy to guess, but I was just using the calculator to show you how it works. So next one, okay, 40, so we know it's gonna be the same, 0.40. Now we do it again, and as you can see, hold on, that's fine, 1, 2, 3, 4, okay. So now we want to go 39 to see what it gives us. It should be about 0.39 as well. What is the last one? 36. 36, let's put one more. Yeah, 3060. It's gonna give us like 38, yeah. Okay, so 0.38. Now 1, 2, 3, 4, and we want to use 30, 60, 34. Okay, so because it's 3, we just drag it up, we get 336, and we just put 0.34 right here, and we get 0.36. 34, yep. Still should give us, yeah, 36. Okay, so we put 0.36, and for last we want to do 0.341. Okay, and want to do 0.322. This is going to give us 0.34. 34. Okay, so once we plug it in, automatically everything just fills in. The yearly dividend, the growth rate, though we get the walk from back here. The walk automatically fills in because we don't need to be doing it here because we know it's from back there. We get the growth rate and the current price of $30, and the intrinsic value comes to 77 according to the dividend discount, which is a very good valuation method. It gives us a pretty high intrinsic value. So that's how we evaluate it, and I'm just going to bring it down here because since we used it, the only model that we've done this one yesterday. We did unlevered dividend discount valuation yesterday. Dividend discount, we didn't do the multiples, so we're gonna take it out. PE based valuation, Graham's, we didn't do it, and the earnings discount as well. So $40. So as you can see, yesterday, because we had two metrics actually. We did two metrics, which was the free cash flow and the unlevered free cash flow. We had, I think 39, let me see, 32, I thought it was higher. But as you can see, just pulling these two right here and their good valuations, it gives us a much higher price valuation. And $40 should still be kind of low. I'm not sure, but let's find out. Yeah, as you can see, according to analysis, professional analysis, the 1 year target's at 38. So this is coming out to be pretty accurate, our valuation. Next video, I will be showing how to find the multiples valuation, the intrinsic value of multiples valuation, and along with that, the Benjamin Graham formula. I don't use this formula a lot, but I'm just gonna do it for the purpose of the video. Also very important, I'm just gonna show the dividend safety, debit to equity ratio, interest coverage ratio, the free cash flow yield valuation, and current ratio. These are simple ratios that I like to cover every stock because these are little things that are actually very important. Okay, hope you enjoyed it, and I'll see you next time.